If you're looking at this chart, you're probably thinking this is a downtrend. Most of the information out there on YouTube are probably telling you that when price creates a higher high and a higher low, this is an uptrend. And once the market shifts and starts creating lower lows and lower highs, this is now a downtrend. Clearly see here the market was making consistent higher highs, higher lows within the range. Then we have a moment here to where we're now creating consistent lower lows and lower highs. Probably anticipating this to be a reversal to reaching back below lower price, only for the market to continue going higher, which you can clearly see right here. Prices of fine support reverses the whole thing. And that's because how you've been taught when it comes to market structure is completely wrong. An uptrend isn't always consistent higher highs and higher lows. Sometimes the market will create lower lows and lower highs as a frame of correction for continuing the overall uptrend. And the problem is a lot of traders, when the market starts creating lower lows and lower highs, they would think that's an overall reversal taking place, not understanding that there's levels of support or resistance that it's simply just referring back into for continuing the overall trend. Problem with most of the information out there is it's too simple. If price just created consistent higher highs and higher lows throughout the whole range, everybody would be rich trading. Sometimes the market is going to be tricky. You're going to create consistent higher highs, come lower, take out this low, then it's going to push higher, take out this low, push higher, take out both those lows, and then create the move higher. This is the reality of trading. It's not always as simple as it may seem. And if you can learn to read market structure like this, you'll get faked out a lot less, win a lot more trades. About to break down everything that you need to know when it comes to market structure so you don't get faked out and start winning more. When it comes to market structure, you want to pay attention to these three specific things. You want to pay attention to short-term highs and lows. This is pretty simple. Basically, when price has three candlesticks, one candlestick in the middle, one to its left, and one to its right. In this depiction, our short-term high would be candlestick in the middle, because this candlestick in the middle is a lot longer than the candlestick to its left as well as the candlestick to its right. This would be our short-term high. The same can be said about a short-term low, where the candlestick to the middle is lower than the candlestick to its right as well as the candlestick to its left. We can mark out this low point as a short-term low. Term highs and lows are very important because this is the basic understanding of market structure. It's where price creates these consistent higher highs and higher lows within the markets. But the problem with the information on YouTube is this is all they teach. Higher highs and higher lows are a lot other components of market structure that you probably don't even know yet. That's going to help you see the charts a lot more clearly and understand what is a strong low versus what is the weak low, a strong high versus what is a weak high. We're about to go over all that later on, so stay tuned. Basic gist of market structure: term highs, short-term lows, price creates higher highs, price creates higher lows. The next thing we want to pay attention to is now intermediate term highs and lows. An intermediate term high can look a little something like this. This is when you have a short-term high in the middle that's above two short-term highs to its left and a short-term high to the right. Vice versa can be said about an intermediate term low. We have a short-term low that is below a short-term low to its left and a short-term low to its right. Reason why intermediate term highs and lows are very important is because of specific traps that the market creates. There are situations to where price can be in an overall downtrend. We can clearly see we're creating lower lows and lower highs. Then there's specific times where the market can come higher and create essentially a higher high. Thing is, the market structure has not shifted just yet, because even though we have created a higher high, it's simply just price coming higher, take out this original high point, and then continue the market lower. So you see here, price comes higher to take out this original high point, see a drop to the downside, continuing the downtrend. Even though we did create a new higher high, this does not validate as a market structure shift just yet. We're going from lower to now higher prices. How you would know a trend is shifting is by paying attention to this one specific level. Let's say we're creating lower lows and lower highs. Price comes higher to create a new higher high. Trend has not shifted yet till we pay attention to this specific level right here. Even though we did come higher to take out this original high, till the market rejects taking out this low, we create a higher low and we start to reverse higher. It's only when the market structure shifts. This is referred to as a failure swing. This is when price fails to take out the dominant leg. Dominant leg in a downtrend is the previous low. As price continues to take out original lows, the overall trend is continuing lower. Price fails to take out that low, and you can clearly see it struggles to continue going lower but instead pushes higher. This is how you would know that the overall trend has then shifted. So an intermediate term high would look something like this. The market comes higher, takes out this original high point, and then we can see price pulls back, continues even lower. This would be referenced as the intermediate term high. We have a short-term high to its left and a short-term high to its right. This is a really good setup within the markets, because this shows us even though price did take out this high point, it was not willing to continue going higher. You can get in on a pullback here here, this is a great sell opportunity. Continue the market trend lower. If this is still confusing to you guys, don't worry, because I'm about to take you guys to the charts as soon as I'm done explaining all of this, so you guys can get a full understanding. This would be intermediate term highs and lows. Another reference of intermediate term highs and lows in alignment with levels of support and resistance. So let's say that the market is in an uptrend. When we're in an uptrend here, let's say price creates a fair value gap. I'm going to extend this forward right here, and price creates this fair value gap. This taps into this fair value gap, then we get a break of structure to the upside. You can clearly see price breaks above this high point. Low right here is referenced as an intermediate term low. And the reason for that is very simple. Price creates a level of support, price comes down into that support, and it finds support to push higher, especially breaking structure from it. That's an overall confirmation that the market wants to continue going higher. Rarely is the market going to tap into this fair value gap, push higher, and then break through it and continue going lower. Usually, a lot of the times once price taps into this fair value gap, sees a push to the upside, now intermediate term low. So once the market pulls back, it will find support to continue going high. Intermediate term highs and lows is two specific things. First is when we have a short-term high above two short-term highs. So the short-term high to its left and a short-term high to its right, as well as a short-term low below two short-term lows. Short-term low to its left and short-term low to its right, as well as when we have a level of support. So this is a fair value gap. Price taps into that fair value gap following a break to the upside. This is also a short-term low. Or let's say we have a level of resistance right here. Price comes back higher, taps into that level of resistance, runs away from it. This high right here that tapped into this resistance, followed by this break higher. This right here is a short-term high. So price should not break back below this high point. This is the overall gist of structure within the markets. When the market is in a downtrend, previous low is referenced as a weak low, basically regular short-term lows. As the market continues going lower, this is a weak low. As the market sees a push to the upside, this does not necessarily validate as a reversal just yet. Reversal until price creates a failure swing, where you can clearly see it does not want to continue going higher and then continues lower. Only a reversal when after price takes out this original high point, then it struggles to continue going lower, then push higher. I hope you guys were able to understand that, and if you don't worry, I'm about to take you guys to the charts. I'm going to break it down in a way that's very easy to understand. Hopefully by the end of this video, you can become a much more consistent trader. I'm currently getting value from this video. I am a trade mentor, and I help people when it comes to making their first $1,000, $5,000, and even some students now that's made well over $10,000 and are consistently full-time traders. You've been trading for some time and you're still not consistent, or you're a complete beginner trying to get into trading. I want to personally hold your hand on the journey, make it a lot easier for you, show you that you don't need to be trained for years, or you don't need to be the most perfect or smartest person. Just follow the specific blueprint in the system that I've outlined for my students and help you make your first $1,000 or even $5,000 to $10,000 within the next 6 or 12 months. So if you want to learn more and talk to me personally, you can click the first in the description, book a free call, get to talk to me. I see where you're at in your training journey, your specific goals, and help create a blueprint to how we can help you achieve it. But we're currently looking at gold here, and we're going to be trading the London session. Before we start trading, we have to create an overall daily bias. Daily bias is pretty simple. It's identifying where have we been, where are we currently at, and where do we anticipate price to go next. Currently, we're in the London session. If you want the specific indicator that I'm using, it's called Kill Zones by @Joshu. It simply just marks out all the different sessions. So breaking this chart down, I want to make it very simple and easy to understand. First thing I'm going to take note of is the previous day high. Then I'm going to take note of this previous daily low right there. These are two specific levels that the market tends to come back into on a consistent day-by-day basis. Looking at this chart, you can clearly see that price is in an overall downtrend. How you would know whether price is in an uptrend or a downtrend is by paying attention to the lows. Not about the highs, but it's about the lows. You can clearly see here, price had this initial spike to the downside, created this pullback right here. Eventually, that pullback could not hold, and price came lower. Take out this low right here. Bam. So first drop in overall market structure. You can clearly see right here, price gave this pullback right there. Did come back higher to take out these short-term highs right here, or continue back lower. This is an intermediate term high right here. See, price came higher, close to take out that intermediate term high, but it didn't, because this intermediate term high is the high that came higher to take out this prior or high in a downtrend, going lower and lower. Price created this lower high. It came higher to take out this short-term high right here before seeing this break to the downside. And the market came back higher. You can see price respects that intermediate term high before continuing low. That's exactly what happened. Price was in a downtrend. You can clearly see it came back higher. higher. It was the lower high right here, right? Lower high. Price came higher, take out this lower high right there, bam, forcing this drop lower. When the marketplace came back higher, you can clearly see it did take out this high point. It respected this intermediate term high right there. After respecting that intermediate term high, you can see this drop to the downside. Of structure would be this high point right here. From up here to down here would be what we call our range. Since we know that this is an overall downtrend, most likely price is going to come back lower, back below these lows, right? Because this was the low here, created this push to the upside. Now that the market is in a reversal, creating consistent lower highs and lower lows, this is the low that price is going to refer back down into. Currently in a reversal, reach back below this low. Obviously, we don't want to be selling down here. We want to be waiting for price to give us a pullback. What we want to do is we want to mark out our intermediate term highs and lows. Right here, this is an intermediate term high. This is an intermediate term high. This is the high that tapped into this bearish fair value gap. Separation between this low to this high creates this bearish fair value gap. You can clearly see price came back into that bearish fair value gap right there, found a level of resistance to go back lower. This is a potential intermediate term high right here. The market opens up and comes back higher. It's going to take out this high right here, may even take out this high. Thing is, should respect this intermediate term high right here. Bam. If it respects this intermediate term high, it then sees a break to the downside. That's our confirmation, frame of short to go lower. And if price does end up breaking through this intermediate term high right here, you have levels of resistance above us. This order block right here, order block because this was a drop base drop. Price had this initial drop to the downside, pull back, continuation lower. As well as we do have this tiny fair value gap up here. My main emphasis coming into the London session is I'm anticipating a push to the downside. Obviously not going to be selling down here. So there's one of two things. I want to see either price give a pullback, not take out this intermediate term high, find a level of resistance to continue going lower, or maybe price give a pullback, take out the intermediate term high right here, and create a new intermediate term high. Once price taps into its resistance level, go lower. Intermediate term highs are based upon two things. It's based upon when price creates this liquidity sweep right there, followed by this push to the downside. This was that intermediate term high. Another intermediate term high is created when price taps into a level of resistance, followed by a reaction lower. Since we tapped into this fair value gap, followed by this reaction lower, this is an intermediate term high. And just in case price does break through it, we have two specific resistance levels up here. Comes back into these intermediate term highs right here and breaks away from it. Then that's our overall confirmation. Continue the overall trend lower. The main emphasis when it comes to overall market structure is not trying to be perfect, but it's waiting for price to come to you. I'm waiting price to come back up here, tell me what it wants to do. There's gonna come up here, reject, go lower. It's gonna come up here, into this resistance, reject, go lower. Not trying to predict the markets. I'm waiting for the markets to come to me, and from that information I can reassess. So I'm gonna let this play out here. We can see the London session opens up. There's a pullback. We can clearly see right here it comes close to tapping into that intermediate term high right there, and then right here, bam, comes close to tapping into that intermediate term high, but it doesn't. And then we can clearly see it breaks through this bullish fair value gap. Right here would be my overall confirmation. As price breaks through this bullish fair value gap, I would frame a short. My stop loss back with this high point, and back below not only this low, but also this low all the way down here. Clearly see here, let this play out. Price ends up finding resistance and gets down there. And trading doesn't always have to be complicated. It's simply just understanding what is the market telling me. We had an intermediate term high right here. This was the high that tapped into this fair value gap, followed by this break higher. When price came close to tapping into that intermediate term high, but it didn't, that was our first sign. Okay, it's respecting that high point. The overall confirmation was when price broke back below this bullish fair value gap. Fair value gaps and order blocks are confirmations. If price is bearish, it's going to break through fair value gaps. Price is bullish, it's going to break through bearish fair value gaps. So the fact that price respected this high point and didn't take it out, and then we got confirmation when price broke through a level of support, gave me the overall understanding, the overall order flow of the markets wants to go lower. So off of that alone, I was able to frame my short. Can clearly see market respects that high and it continues even lower. Not about overcomplicating it or being perfect. It's just about reading the markets, waiting for it to come to you, then allowing it to give you an idea of what it wants to do. So I'm gonna remove everything off my charts here and go into the next example. London session is just about to open up. We want to take note of a few levels. I'll take note of this original high point right here, as well as I want to take note of this low right here, as well as potentially these lows all the way back down here. Also gonna take note of this high right here, and potentially these specific highs up here. Right here we have a couple levels. This intermediate term low right here is simply just a short-term low. Is this a short-term low versus this an intermediate term low? Intermediate term low has a short-term low to its left and a short-term low to its right. Term low has a short-term low to its left. It does not have a short-term low to its right. It's not validated as a intermediate term low or a strong low within the markets. So markets here, I want to pay attention to this specific level. This is the last down close candle, seeing this push the upside. So obviously this is a support level. If the market breaks through this last down close candle, our next level of support would be this fair value gap. Why we want to mark out this fair value gap is because none of these lows are intermediate term lows. A regular short-term low, a regular short-term low. None of these lows have a short-term low to its left or short-term low to its right. Price is most likely going to break through all of them. Most likely it's going to revisit the fair value gap down here. When it comes to overall market structure, you have to mark out specific short-term lows, intermediate term highs and lows. This is an intermediate term low. This is a strong level of structure within a market. I don't want to see price break through this level. If it does break through this level, another strong level of structure within markets is going to be this fair value gap, which is a support level. I mentioned intermediate term highs and lows are only created when price has a short-term higher low to its left and its right, whether price taps into a level of support and resistance. I'll let this play out here. See here that the London session opens up. It sees this initial reaction to the upside. That's pretty good. The initial reaction to the upside right here, you can clearly see price is struggling to continue going lower, and instead it's making an effort to reach back over that high point. At this point, I want to take note of this last down close candle right here. We have an idea of higher prices. Now what we want to look for is confirmation. If price can come down into this last down close candle and it struggle to continue going lower, and instead it finds support here to push higher, that's my overall confirmation. Price simply came lower to take out this low point, and once it took out this low point, should now be finding support to go higher. See, price comes out into that last down close candle right there, comes out into it once. Want to pay attention to this low, then we can see this push the upside. At this point, I can frame my long setup and I can put my stop loss back below this low right here. And the next level I'd want to be reaching back up into intermediate term high up here, the short term high to its left and a short term high to its right. This is the next level of liquidity. The reason why I'm targeting this intermediate term high is because price showed that it does not want to take out this intermediate term low. You can clearly see we had that order block right there, rejected from it, see a push to the upside, then we got the confirmation at this order block where you can clearly see price did not want to continue going lower. At this point, price is obviously telling us that it does not want to go lower. At this point, I can frame a long setup, put my stop loss below this low because this is the low that tapped into this order block, followed by this push to the upside. So this is a strong low, but if you want to be extra careful, put your stop loss back below this low as well. This is still a good stop loss. At this point, I'm gonna let this play out here. You can clearly see price sees a push to the upside, takes out this high point. We had this push to the downside, take out this low, higher, take out this high. Now we're anticipating a pullback to find support and push higher. This last down close candle is our order block. I want to see price come down into this level and support to push higher. You can see price comes down into it, finds support there, takes out all those highs. And this is probably one of my most advanced videos on market structure. If you have to watch this a couple times, then definitely do so. But this is the reality of market structure. Sometimes the market isn't always as simple as higher highs and higher lows. Sometimes there's intermediate term lows to a level of support, sees a push to the upside. Sometimes a market structure could look something like this, where it comes lower, takes out both these highs, expects this high, and then continue going lower. The market isn't always as simple as you think. If it was so simple, everyone would make, 6 figures a year trading like I do. Even though the market isn't simple, it's not complicated. This is what I teach my students within Spark on a consistent day-to-day basis. Obviously, you're not going to master this overnight. As you continue to show up, you continue to watch these YouTube videos, you continue to understand more and more, become a much more proficient trader. I give you guys the reality of trading. It's not easy. I'm not going to tell them, oh, learn this 80% win rate strategy and you become profitable. Now, you have to put in the work, have to show up, to do a daily back testing, the homework assignments that we give you. And as you put in the effort, as you put in the work, then you can make those strides. Make your first $1,000, make your first $5,000, make your first $10,000. It's not going to be overnight, but we help our students the best because we give them the realest information, the realest knowledge. We tell them it's not going to be easy, it's going to be difficult, you're going to suck at the beginning, but as long as you continue to show up, as long as you continue to put in the effort, you will become a consistently profitable trader. I generally believe everyone watching this video can become consistent. The reason why you're not consistent yet is because lack of education and knowledge. A lot of people on YouTube are teaching you it wrong or oversimplifying it or putting it in a way to where you don't understand, as well as other things like you don't have a mentor alongside you help you when it comes to psychology, risk management, trade management, as well as the overall experience in navigating different market conditions. That's why I've built Spark and why we have one of the best student testimonials. Every single student, it's your first payout, their first $5,000-$10,000 trading. Some students are now full-time traders. So if you want to become one of my students, learn from me directly, become a consistently profitable trader within the next 6 to 12 months, click the first in the description, free call, talk to me personally, let me see where you're at and how I can help you. It's gonna be it for the video. I hope you guys got a lot of value from this video. Make sure you guys click that like button, subscribe if you're new to my channel, and comment what you guys want to see next. If you want to watch another video that I uploaded the other day that goes over every single ICT concepts in only 24 minutes, as well as towards the end I give you a step-by-step training plan, that video is about to pop up right now, so make sure you guys check that one out. I'm your mentor, Arkhamtrades. Be safe.